Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. Today we've got Nathan Fisher with us, and we're going to talk about commodities here. We're going to deep dive. We're going to go back and forth. It's not going to be me just interviewing him. We're going to go back and forth and get into the weeds here a little bit, give our opinions. Again, they're just our opinions. We're still learning about this stuff. We're diving deep, trying to figure out, kind of wrap our head around what's coming ahead of us, maybe a paradigm shift. We're coming from a disinflationary period, a 40-year disinflationary period. Things are changing in the markets. I think Nathan's seeing that. He wanted to talk about commodities, and he wants to share what he sees that are changing in these markets for what potentially could be coming ahead of us, and that we're currently experiencing. I'll call it in this transition, where we're going from a disinflationary environment. I'm guessing you're going to say more inflationary environment in front of us, and how certain asset classes are going to benefit from that. So thanks, Nathan, for coming on. I really appreciate it. And if you can tell us a little bit about your background, kind of what got you interested in this thing that's coming up. We'll call it the commodities cycle, super cycle, however you want to call it. And just give us a little bit about your background and how you got onto commodities.
Sure. So my background by trade is that I'm an IT manager. So what do I know about any of this kind of stuff? Well, I do have an MBA. I'm intensely interested in business. I've been an avid gold and silver and minor investor since about 2019. We talked briefly about this beforehand with the repo crisis issue. I really wanted to get involved in how to hedge against the real estate holdings that I had if there was a crisis that occurred again. So the basis for a lot of this that you're going to see here, I would have to say the original beginnings of this has to do with some of Mike Maloney's wealth cycles. So with anybody that's done any kind of research papers before, you start with a basis and then you build upon a lot of that. So I kind of I write these massively long articles on renaissancemen.org. And then with that, I occasionally I do some of these types of interviews and discussions where, we kind of go over some of this because, if you want to read some of these things, it might take you an hour or a half a day. So, yeah.
Okay, so you had prepared a presentation for us. Maybe we can walk through that, and we're gonna go back and forth and just discuss, maybe the merits or the shortcomings or whatever it is with that slide.
Sure. So with this, I'm going to start off for the first 5 minutes or so. I want to kind of talk about asset classes and money, because a lot of people confuse cash currency with money, because that's kind of what we've been led to believe over the last 50 years. So I'm going to kind of start with the background of some of this. So for instance, if you went like 100 years ago and you had a vault and you put 1 ounce of gold in there and a $20 bill in there, they were of equal value. So the question then is, 100 years later, you open up the vault. Did that gold just approximately increase its value by 90x, or did the dollar itself decrease in value? So most people looking at this and they see the word appreciation. And partially what I wanted to go through this is show that that's not necessarily the case. So starting with that, I wanted to have currency on the left-hand side here. Currency is what you're referring to as cash, US dollars, and that's completely different than money. Now, I have 3 different asset classes here, which is somewhat similar to what Mike Maloney was talking about. He had gold, he had stocks, and he had real estate. So I'm going to talk about these asset classes a little bit because I've expanded them, and you'll see how commodities or money is part of my definition. So with that, like currency, if you think of electric current, it goes between different types of things. And the longer distance that the electric current is between them, the more heat loss and voltage loss that you have. And with that, with currency depreciates in spending power over time. So you can see if you held, a $20 bill in a vault for 100 years, it lost 99% of its value. So the concept here is, yeah, you may sell stocks. Yeah, you may sell property. You may sell things and you get to this currency, but what do you do with it? And for that reason, you worry about holding it for any period of time, because what we've seen with inflation is you could lose 5, 6, 7, 15% of its value in a single year in spending power. So that's the overall with the asset classes. And recently, I had seen somebody write about how Zoltan Pozar, I love that name, by the way. He had written, I think it was February of last year, that commodities are collateral and collateral is money. Now, I've been writing and doing videos about this kind of thing for the better part of about 2.5, 3 years from now. And when I saw this, it kind of jumped off the page at me as like, wow, like, somebody else is in the corner. Because when I created this image down below, I was kind of laughed at and ridiculed a little bit that, like, wait, cows are not money. Uh, correct. But anything you have like this that you can borrow against. And I'll get into the different types of monetary systems in the future. But for now, we think of gold as money, but in reality, what gold is it's the best form of money because it lasts longer than all the rest. Now, the very top of this, you may have fresh food. Now, obviously, you can't eat gold, but fresh food has a decaying value. So, long story short, is that if you can look at commodities, the best form of money within commodities is something like gold and silver and copper that lasts a lot longer. So that's kind of how I would value the money. Some of these things have a decay with them. And also within the money asset class, if gold is the best form of money, what you start to see is other commodities over the course of thousands of years have relationships with gold that can go back. And it's kind of like a sine wave. And you can see that, like, you can see this with oil here to an extent. Whereas if there's too much oil that's in production, people would potentially use gold and buy more oil. And, the solution for high prices is, what is it? The solution for high, what is it? High prices, high costs, whatever it is.
Prices.
Yeah. So I'm butchering that. I'm butchering that. The
High
concept
prices
is,
solve high prices.
the concept here is that between the two of them, they have a relation. And with that, if gold is the center of this, then you can think like houses. Houses are built with lumber. They're built with drywall. They're built with labor, and all of these things you can break them down at, and they all have relation to a gold value. So a value of a house, you can break this down to labor and materials, and all of those things would have relation to gold. Like, thousands of years ago, they may have paid soldiers in silver, and gold and silver had a ratio for thousands of years. So pretty much everything today that's an end product could have its root in a value based in gold.
Yeah, can I make a comment on that too?
Go ahead.
Yeah, we can go back and forth here. So I look a lot at ratios. Ratios tell you a relative valuation of asset versus asset over time or over history. Ratios also tell us the market conditions that we are in and what we are experiencing during that time frame. So what you're plotting in a ratio is actually the supply and demand balance with the dollar value taken away. And that supply demand balance shifts during certain market conditions. So when you look at certain market conditions, you can look at the different assets, you can calculate the ratios, and you can actually identify where we are in certain cycles, given where assets are being priced against each other. So it's another way to actually verify what the market conditions are and how we are doing and how they are changing against each other in a cycle. And what I found, if you look at history, the thing that changes the asset pricing and all those ratios is generally interest rates. So as interest rates go up and down, it forces money or draws currency, we'll say currency, into certain sectors. And you'll see these things blow out. So in a disinflationary environment for 40 years, what we would see is a lot of currency in bond markets and a lot of currency in stocks. And when you price that against other assets like commodities, gold, or whatever derivative of commodity like oil, whatever it is, you're going to see that those are incredibly low. They were at 100-year lows in relationship to the financial assets. Now, the question that everyone should ask is, what causes interest rates to move? What is the driver of interest rates? And in my opinion, it is inflation or deflation. And then you go back and you say, why, what drives inflation and deflation? And in my opinion, it's actually the demographic of the United States if things are being priced in dollars. That's the reserve currency. So in my opinion, it's actually the demographic that's driving inflation and deflation, which drives interest rates, which then prices all assets in the world, weirdly enough. But that's my take on it. Obviously, you can have your opinions on it as well. And we can go through this if you'd like. So that's kind of what I found. And I know it seems kind of weird to some degree.
I'm going to talk a little bit about M2 down the road, a little bit in this, but the next asset class here was business. The Maloney had just talked about stocks here, but I essentially talk about it as kind of any yield bearing asset. So my rental properties are business. I get cash flow back from it. And different types of businesses have higher risks. And with that, you hope to get paid a higher reward. So bonds are pretty much on the lowest risk side, but they also have the lowest level of return. So that being said, is if you want to put cash into these classes, it also depends upon the economic background of the country or jurisdiction you're investing in as to how much risk appetite you have for your return. And that's why, Rick Rule talks about how his background was in credit analysis. So he could find, where there was definite opportunities where things were perhaps mispriced, where there was a much higher reward there with a lower level of risk. So with that, you want to put, oh, go ahead.
When you define risk, how are you defining that statement there? Risk, is that based off of volatility? Is it based off of,
it could be, it could be a lot of different things, but you would have the Rick Rules of the world perhaps saying, hey, your credit rating is too low. And if I'm going to give you something, I need to have a higher level of return in order to lend you that money. It could be that, it can be how somebody discounts a jurisdiction risk of sorts. So there's a lot of different things that can go into how you would evaluate the risk that's in something like rentals. What is the risk of investing in a rental? Well, you have to then look at the actual structure itself. What repairs are needed? What is your cash flows you're expecting from it? And if these numbers don't match up, then it's a high risk investment. So there's a lot of different factors that go into figuring out what risk is. But the basis here is that if I'm going to lend you money, I want to make sure that I price my risk in properly with this, so I can get an adequate return from it, and I don't lose my money by investing in you.
Because the way I view risk is maybe different from other people. Risk is buying a house or buying rentals at the top of a property market. So the way that I would reduce my risk is to buy at opportune times during the 18-year property cycle. And then when I look at stocks, I view to hold stocks as a very risky venture if you're in an inflationary environment where interest rates could go up. Same with bonds. So the way that I view risk is understanding the cycles versus the actual asset class and the risks within the asset class, which I think you described quite well there. So maybe I just view it a little bit different.
Well, it's interesting though, because you're talking about relative risk, whereas like, for instance, I bought my house here in 2013, 2014, whatever it was. And remember, like the real estate market was terrible. So, you're putting a risk in to buy something that the value could keep going down. So it's not necessarily that the risk was gone. It's just that potentially, if you look at that value to gold or other things, it became stretched, whereas you could cash in your gold and then buy more real estate towards it. So it was kind of an arbitrage opportunity, if you will, and not necessarily riskless. Okay. So that's kind of how I was looking at it, if you will. So
you buy high risk assets at the lowest risk time. Let's put it that way. Yeah.
So with that, with the business ROI, I don't want to go into this too much. But the bottom line is you want to put money into something and you're getting something out. You can use labor, you can buy raw materials, rents, and the like. So what you're looking at with businesses, you're looking on a return on investment, if you will. So bottom line is that's the second asset class. The third asset class I talk about is property. This can be houses, land, but it also can be like baseball gloves, washers, dryers. Now, these things provide utility. So, if you buy like a car, you drive it off a lot, it loses 25% of its value in 10 minutes. Okay. So you have a loss of you lose some of that investment as you use it. Okay. With houses, think about the maintenance costs that you have with it. If you don't do anything with the house, it's going to lose value very rapidly when the roof leaks. So with the property, it's a third asset class to put things into, and I'm going to talk about how they're overstretched each other and the like in a second. So the 50,000 foot view of what my 45,000 word blog post was about was, it seems to be that coming up, I believe that there's going to be a rotation from high risk business and property to money, and with that also the low risk business, like some certain bonds. So as you can see in that business class, there was certain ones that were low risk versus the high risk. So maybe you're selling rentals at the top of the market and then converting some of that to bonds. Maybe you're selling some of these high value rentals at the moment, and you're converting a very small portion of that to gold or silver. So you may find a way to take an overstretched asset and then put it into an undervalued one. So with that, you talked about interest rates as well. And when you're talking about Fed funds rates going up and the like, you're now passing on higher costs to buy a house. And if Fed fund rates are 4%, 4.25%, whatever it is today, when you go to buy a house, you're looking at 7-8% mortgage net. So your monthly cost that you would have for this house would double. So you're like, you know what, I'm not going to buy right now. I'm going to wait for a better period of time. So this is going to reduce the amount of supply that's built. And with that, you're going to have more amounts of unemployment. Long story short, within business, if your cost to borrow things, like you want to build up inventory and you want to borrow to do that, you now have higher costs to build up inventory, to build factories. And so now you start having lower earnings. And this also now, instead of these stocks being, 40, 50 PE ratios, they're going to start to correct down to perhaps 10, 15. And with that, you're going to have a rotation out of stocks as well. So if people are selling high value rentals, if people are selling stocks, if people are selling their house that went up 4x in 10 years, if they're selling this stuff and they're putting it in a currency, what are they doing with it? So also with this, I'll get into some of the US dollar issues in a second, but I'll show you in a chart in a bit about how commodities, also gold, are significantly undervalued against other things. So also one of the issues with this that I'd written in this is that commodities have been severely underinvested in the last few years. We've seen it with the LME nickel blow up. We've seen the LME supplies now are pretty much at all-time lows or 25-year lows I'd seen. You're also seeing reports that we're going to have structural copper issues by 2035 because these 100-year-old mines are running out of mining abilities. There's not enough mines that are coming online. It takes 10, 15 years to build some of these things, billions of dollars. They're not invested in. So you're going to see all this money then potentially going into something that's, as you mentioned, I mean, we're at like a 100-year commodities lows relatively speaking. And when this money starts coming into it, it could be a fire hose, but there's no copper. So what's going to happen? It's going to take a lot of investment. The price of these things are going to start to go up, and that starts to incentivize more mining. So that being said, is one of the little theories I had here was these Fed fund rates went up massively and quickly because I think inflation was running so hot that if you looked at the warehouses and these metal supplies that were running desperately low, think about what happens when all of the United States manufacturing screeches to a halt because nobody can get any metal. That just destroys, that's instant depression. So I think if you jack up the Fed funds rate very quickly to fight inflation, you have to give a cooling off period to allow some of these commodities to be able to restock. But in order to restock, these commodity prices need to be higher. So you had to see a sharp Fed funds rate. And this is part of what my theory is that I also think this Fed funds rates are going to stay higher and elevated for longer than anybody thinks it's going to happen. So that was also part of the article. I go deeper into that.
So we can go back and we can talk about that. You said a depression. Is that what you said? If we run out of metals or something like
Yeah,
that?
I mean, if there's absolutely no raw materials to build things,
Hmm.
how do companies actually make any money? I
Agreed.
mean,
Yeah. So
yeah, I mean, unless you're a
what if we go
service
back?
company.
What if we go back and define? I just kind of want to define some stuff for the viewers real quick. Um, you've got your money supply, which is M2, and then you've got your GDP. Those have to go up kind of in tandem. Otherwise, you'll get an imbalance between money in the system and your gross domestic product. The gross domestic product, if you were to break down a company, like just to look at it from a high level view, companies take commodities and convert them into products using energy. It's as simple as that. And then you look at the base, you've got the feedstock of commodity companies that feed commodities to these companies all around the world as their inputs for these production facilities. That also takes copious amounts of energy. The problem that I see potentially, and I agree with you 100% that there's going to be commodity shortages that come, is it's going to be highly inflationary because of it. You've got M2 money supply out here, and your GDP is going to do this. And then you get a mismatch between how much, I'll say currency, how much currency is in the system versus how many goods and services are in the system. The question that I've always asked and that I'm always worried about is you're going to have a hyperinflation. Because if the money supply cannot, it has to grow in order for the system to survive. And if your GDP cannot grow, you get a mismatch between money in the system and your goods and services. So you're going to see massive inflation if we were to run into a commodity or many commodity constraints. May that be aluminum, nickel, zinc, copper, cobalt, lithium, and more importantly, oil. If we see a shortage in oil, all of these shortages in metals is future energy demand. Would you say that's a fair statement? And they're all at lower ore grades. As you go down on the ore grade curve, you go up in an exponential fashion in your energy inputs. So in my opinion, the master commodity, the thing that's going to basically, I'll say, pace this entire thing is oil. And oil is going to be the thing that can destroy currencies. And I think you're going to start to see bond markets start to collapse because you're going to see constraints in oil. Now that's a big, that's a big statement there, but I do think that will come at some point. I just don't know when the point is. What's your take on it?
So one of the things you mentioned there, you talk about inflation, and I'll tell you what, if you talk to 50 different people and ask them what define inflation, you're probably going to get 50 different answers if you really think about it. But one of the ones that I like the best for, actually is very relevant to this discussion here, is essentially just the money supply. And I say that because let's just say you have all of this M2 that's being borrowed into existence. Now we saw in 2020, 2021 with QE and the like, how $6 trillion got borrowed into existence. Okay, rapidly. It was something like 40% of all money supply ever. Mm-hmm. Now, what I'm talking about here is how this money already exists and it's sloshing around. So what you see as commodity price inflation is actually money that's rotating from stocks, fighting for the limited amount of quantities of metals that are available or commodities that are available. So the end buyer sees it as price inflation, but the money is already in the system sloshing around. It's just going to start finding it. And when that money starts, when that currency starts finding those commodities, that's when you start to see that price inflation. So I would want to probably differentiate here between price inflation of commodities versus like an M2 hyperinflation of money supply, because you can't have a hyperinflation of commodities because you're limited with the money supply that's in existence, unless more is borrowed. But if you have interest rates 8, 7, 8, 9%, no one's borrowing it more into existence. And what I didn't add here, which I put in some of my recent writings, is in the past year, this is the first time in my life, I'm 47 years old. It's the first time I saw on a chart in my life that the M2 money supply actually contracted. So what's that telling you? It basically, we're going to have to keep borrowing money into existence. But in the short term, it's going to essentially stop growth of business. It's going to stop real estate. And with that, you're going to have people selling at the peaks of the market. That cash is then going to rotate into something that's severely undervalued. So that's where you get the price inflation of the metals. So again, I mean, you ask 50 different people the definitions of inflation, and that's, you're going to get many different ones. That's just my take on it.
Here's another thing that we can talk about real quick. We've got money that was created that went into financial assets, and then we have money that circulates in the system, right? I don't know if that money coming out of M2 is coming out of the system. As you can see, your money velocity is kicking up. I think it's money they parked in financial assets that they're taking off of balance sheets, and the money in the system's still coming around. It's still floating around. So the way that they measure it is they measure it through consumer price index. The consumer price index, I'm just stating this for everyone, is a measurement of basically housing, energy, and some other stuff that they may measure in the system that's floating around. And metals are going to have a huge impact on that. What happens if your GDP collapses, but your money supply stays the same, which we've never seen before? We've never seen. Everyone's paradigm looking backwards for this 40 years has been increasing energy, increasing metals, increasing commodities on a decline of commodity costs the entire time. Now, what if that completely reverses and goes up, where commodities become extremely, we'll call it extremely, a lot more rare than what we've seen in the past, and energy becomes a lot more expensive and hard to come by? Can this blow up the entire system at the inflection point of a declining commodity move, then to an increasing of commodities? Now, we can see that when I do technical analysis on charts, the PPI to CPI ratio, or the PPI to CPI ratio, is putting in a double bottom ready to break to the upside. It's saying that the market is positioning in a way saying that paradigm is done. Now, that paradigm being done, the system and the money supply, the way it's designed, cannot handle that. In my opinion, it cannot handle an ever increasing price in commodities or oil. So I think where the checkmate that I keep thinking of, and I'm just throwing out ideas, I'm not stating these as facts, I'm throwing out ideas, is we need to figure out a way to ever increase commodities ad infinitum. And if we cannot, which I don't believe we can, at least if we're constrained to Earth, is how do you, we're going to go to lower and lower ore grades, which is going to exponentially increase your energy inputs. We are having problems with oil right now. I think that's why, and I'm going to throw a bunch of stuff out here. I think that's why they're doing climate change. The climate change is not a problem. It's actually oil-based and energy-based, and we have to move as rapidly as possible to something else because we're about to hit the peak of something. And I think they know that. So they're trying to slow everything down, jack up interest rates as fast as they can. We're in another cycle as well for the demographic, the millennials. I know I'm kind of going around here, but if we don't increase GDP and that money keeps going up, I don't know how they're going to solve that. It's going to break your currency.
There's a couple things that go into play here. First of all, many can argue that GDP is relatively an irrelevant marker today, with how a lot of things are done. And it just, if you look deep into it, GDP might not be the most accurate way, and it can be juked in certain ways. And then they talk about the velocity of money within that. And the velocity of money is not a real-time thing. It's retrofitted backwards to kind of, so they can kind of determine how fast things have been moving around the economy. And I get that, because a lot of the things that make money in the economy is friction. Think about any transaction you make, any financial transaction you make, the government gets their beak wet on pretty much every one of these transactions. So the more transactions you make, the more GDP, the higher the tax revenues, all that other fun stuff. So they want to keep the system lubricated. And if they want to keep the system lubricated, the worst thing you can do is jack up rates. So with that here, I'm going to move on a little bit into this to go further, because yeah, like the big picture of a lot of this, like I mentioned, the money is, I believe the currency is going to move a lot from these places that are at peaks, and it's going to rotate into the commodities. But we had also talked about a little bit beforehand with housing that I don't believe our housing market is going to get destroyed here. I think there's pockets that are very bad, but you'll have places like Canada, like Toronto, prices are insane. You have places like LA, Denver, Austin. These places went insane, but you also have things like Australia and Hong Kong. These places didn't have their 2008 global financial crisis. So you may have worldwide real estate issues with then getting into currency. Plus, I mean, I think last time I saw this, there was something like 17 trillion in currency in US dollars offshore. I'm going to talk about how some of that is also going to potentially come back onto our shores. So I also talked about how the mines take 10 to 15 years to build. Supply issues can stop assembly lines. But also here, the relative valuation. So we talked about the M2 and the like. So when you borrow all this cash into the system, it sloshes around. So money's borrowed into the system, cash is borrowed into the system, whatever. Sorry, Maloney. So when this is borrowed into the system, it finds its most efficient place to be. And this could be, stocks are soaring. Expansion is great. Lower regulations allow for better business. So money may flow into these types of things. Hey, now might be a good time to buy a washer or dryer. So these are the good times. But then also when you start to see contraction, it now starts to find a way to preserve that financial energy. The best ways to preserve the financial energy are to put it into gold, silver, but probably bonds, treasuries, those types of things. So that's the defensive way. So right now, I can make the argument that we're in a massive rotation about to go into bad times. We have not seen a recession since 2009. So probably half of your viewers have never even seen what a recession is. I lost my job twice within a year during that period of time. So with that, you'll have gold and commodities, in tough times over the last decade, because think about how the prices came down. There was no investment. Silver's in deficit right now, and there's not a whole ton of silver mines coming online. Any silver primary producer you can think of in the last 3 years right now is probably producing gold or a base metal as their primary metal now. Primary silver producers can't really even exist. So with that, you also can see an issue with deglobalization. You were talking about 40 years where the prices of commodities were coming down, right? And prices of commodities are going to start to go up. That doesn't mean the commodities, again, like the gold in the vault, the commodities didn't get more value. You're going to need more dollar currency units to buy it. So with deglobalization, it's going to make the cost of these things start to go up in terms of US dollars. So with that, I'm going to talk a little bit about how this is kind of forming out to be like a BRICS plus versus a G7 plus kind of commodity / trade war going on. So we talked about the M2. This chart here, I'm not going to get into it too much, but the M2 goes up, and all other these asset classes are going up over the last 60 years, but they take turns leading and going into peaks and troughs. So you can see where gold peaks and then comes back, and then gold peaks and comes back. But then likewise, you can see in this blue line here, this chart's now about 2 weeks old, but you can see how overstretched that our markets are relative to our M2 / gold / property. You can see it's so far overstretched that you can see it potentially coming and snapping back down. And where is that currency going? It's going to get sloshed around. So some of the problems you have today, I'm going to go through a couple of these things real quick. So I believe that the big issue that we have today, the huge issue, which drives a lot of this entire theory, is what happened with Russia with SWIFT. I think a lot of people right now are worried about losing their reserve currencies in US dollars or gold being seized. If they disagree with us, we will take their reserve currencies from them. We've seen over the last 11 years that they went from 65 to 60%, but I believe the recent events are having pretty much anyone right now with US dollar denominated assets, treasuries, US dollars, looking for other ways of holding reserve currencies. It does not mean the US dollar will die tomorrow. But if you go from a 60% world currency down to a 40%, what that means is you need more dollar currency units to buy things from other countries. That's the implication here. So what we also mentioned about is during the time of the pandemic, You know, that money sloshing around, the currency sloshing around, 40% of all currency ever created was created during this time period. And it has yet to slosh back into commodities. It all went to stocks and crypto, and stunks go up, and hey, I'm going to have a Airbnb house and I'm going to get cash flows from it. All these things are going to start to revert, and that cash doesn't disappear. It starts moving into other things, and that's defensive assets to me. So the next point here is, this is a huge thing you're going to see on FinTwit, is that most people confuse what the DXY is, the strength of the DXY, and they confuse that with the dollar strength against money. The dollar strength against money. Remember the gold ounce in the vault against the $20 bill, and 100 years later, that gold did not increase by 90x. Okay. What happens is the dollar strength against money over time decreases. So people see, oh, the DXY is 104, it's 102, it's 100. Who cares? When you're talking about a global issue where US dollars are getting run out of, you know, foreign countries are potentially selling off our treasuries right now. They're getting into US dollars and then defending their own currencies. So if you confuse the DXY strength right now and you think gold's not going to go up because the DXY is going to go up, that is a poor way of thinking about it, because at some points in history, gold has gone up with the DXY. So don't think that that's going to be an inverse relationship. If you're listening to certain people that think the DXY is going to go higher, it does not mean gold's going to go lower. It could, but it doesn't necessarily mean that if you look at it against a global backdrop of how the US dollar is being used globally right now. So I also mentioned here about how inflation got really hot, the sharp Fed funds rates. That's a huge problem where you could have had a lot of other things go nickel. And lastly, the big problem here, you talked a little bit about GDP and the like, and how that's friction in the system. But you're looking at our markets. I think that the high frequency trading actually kind of makes our COMEX somewhat like a joke. Now, it accentuates more in the silver market because it's such a small market compared to other commodities. And it's very easy to put a tinfoil hat on when you see these companies getting fined $920 million for manipulating silver. That being said, these other markets are so much bigger that price manipulation does happen, but it's like salami slices. It's death by 1,000 paper cuts. And what this has done over the last 50 years is this has driven a lot of production to third world hellholes in the middle of nowhere. And so the price to do a lot of this stuff is next to nothing, but the security there, the jurisdictions there are horrible. Look at how you get cobalt. It's basically slave labor in Africa. And at what point in time does that end? Because these countries that are producing this stuff can't produce it for any cheaper than they're already doing it. So these prices are going to have to start coming up. So, and if a lot of these countries are aligned with BRICS Plus, and these BRICS Plus currencies exchanges start getting stood up, and they're giving you higher prices than the COMEX is, I feel like in the next couple of years that you're going to see the BRICS Plus exchanges start to be the price makers instead of the price takers. Now, what does a BRICS exchange look like? I'm not going to go deeply into it, but part of this article basically said that I think you could have a point in time where gold is the pricing mechanism within these BRICS exchanges. It doesn't mean you're selling cows for gold. It means that, you know, you may enter gold into the system and get like a BRICS token back, or a BRICS currency. You're minting BRICS into existence. And then remember, as I said, gold is related to pretty much every commodity on the planet. So you can then have a real-time exchange with gold in BRICS approved vaults. And then everything is priced in grams of gold, or you can say the BRICS Plus currency is equal to 100 grams of gold, or whatever it is. But all of these things trade relative to gold, oil, silver, copper, all that kind of fun stuff. So that is kind of what I can see right now, is that these exchanges are going to get stood up and start sucking a lot of our resources that we're buying right now in US dollars cheaply. If you can get $1 more, $2 more an ounce for something, or $5 more a pound for something else, you're going to sell on these other exchanges. They're going to take all of our supplies from us. So with that, you have any comments on that at all?
Yeah, so the only thing I'll say is the reserve currency, being the reserve currency, gives us a lot of buying power and a delay of inflation in the USD. So if you were to take the reserve currency and really drop it all the way down to basically a very low amount, what happens is a dollar is a future repayment. It's debt. So America is going to have to pay back those dollars with something. That something is either a piece of property or something commodity related, or natural resources or something, or a converted commodity that's a usable product. That's final payment. So what happens is these countries are holding reserves of dollars. They have to hold them because they have to buy commodities in dollars. And when that all reverses, those dollars are going to go searching for something to buy. That's all inflation. So when I look at that, I'm like, oh, okay, this is bad. Because when reserve currency drops, it's all future buying power.
That's what I'm getting at. Because if you have all these countries around the world that don't need US dollars to buy things anymore, we're seeing it right now. China is buying oil with the yuan. You can see Ghana wanting to buy oil from Russia with gold. You can see that many people are trying to find ways around the US dollar. And with that, it's a supply and demand thing. So other currencies will start to make more of the reserve currency. It doesn't mean that the dollar is going to go to 0% tomorrow. It means that maybe the US dollar may go from 60% today down to 25% in 10 years. Well, does something else going to be the dominant, or could it be a BRICS plus type of currency that's a rival to it? So I don't know how that's going to play out, but I think this slide here, I wanted to talk to you about the gold bugs. Okay. Cause I'm one of them, but life has evolved from all of us. And this is kind of what I've been coming to. And basically 150 years ago, you had this gold backed system. And I'm choosing my words carefully here. Gold backed. You take that $20 bill, you got an ounce of gold back. Okay. Now that was a one-to-one thing. So that was a savings-based type of system. Now, if you look at it, what we are today, we're at essentially a credit-based system. So if you have, for instance, a gold-based system, you can borrow against it. You can potentially create credit against it and use that as the collateral. And that's what Zoltan was talking about that I mentioned above, because if you have all these commodities, and right now China is doing that with copper, they're levering up, they're lending out based on their copper stocks. And you can start to see this, that, maybe countries that don't have gold, well, they got oil. Maybe Chile, you got a ton of copper. These countries might then start to be able to borrow against their stocks, or at the very least sell them on a BRICS plus exchange, and essentially, you get the BRICS plus currency back where you can buy international commodities with it. So it can rival the US based systems. It doesn't have to replace them. But if you start to, the US dollar starts to go from 60% of reserve down to 30, 40, 25%, it starts to hurt. So I think all the gold bugs that want a one-to-one gold back system again, I don't think they realize, and here's what my findings are. In the last 120 years, what has happened with the amount of money that we could borrow into existence? Look at the technology that's happened. Look at the advancements in science, in weaponry, and everything that we've done because we've been able to borrow money into existence. Now, yes, it's inflationary. However, you can see with that chart above, everything kind of inflates all with it. It just, there's different cycles that go back and forth with it. So I would tell the gold bugs, a gold back system may never exist again. But if a BRICS plus type of currency, a BRICS plus type of exchange existed, where gold is the center of that trade, there's your gold-based system. And if countries mined gold out of the ground and wanted to sell it into this exchange, they can then get, rice, grains, whatever they want to get from it. And countries that, make oil but don't make food, they can sell into this BRICS plus exchange. So the gold-based system is essentially the universal translator of all these goods. And it's going to vary. Some days you may have 1.2 grams per gold for a barrel of oil. The next day it might be 1.18. The next day it might be 1.23. And as you mentioned, supply and demand cures all of that. So that's how it can kind of work. But this exchange is going to be a physical based exchange as opposed to the COMEX right now. How many paper contracts are there against gold and silver right now? It's ridiculous. It's not really a physical based exchange. So why on God's earth is a non-physical based exchange creating the price point for everything? You have to ask yourself that. Now, could it be a great mechanism to use for hedging future production? Absolutely. But why is it being the price setting mechanism if it's not a physical exchange? So I can see over the next 3 to 5 years, those who are producing commodities in these BRICS plus nations will start to become the price makers. So that's ultimately where you're going to see a massive explosion in the price of these commodities, because these people, in a lot of these, I'm sorry to keep saying the third world jurisdictions, but if you're, Papua New Guinea and Barrick is there and they're mining a whole bunch of gold out of the ground, don't you think they're going to want a taste of some of that gold as well? Now, you can nationalize it, which doesn't make any sense because no one will ever invest in your country ever again. Ghana did something that was amazing. They said, hey, how about this? How about, I know you have a bunch of local miners and expenses that you can pay in our currency. So 20% of your gold production, you sell to us in our local currencies. That gives that local country exposure to those minerals that are being extracted. It allows them to defend their currency against the US dollar. And it allows them to, have commodities that they can then sell to other countries instead of just getting paper US dollars in taxes. So this gold backed versus gold based, I think they have it wrong that China is going to do 1-to-1 with the yuan or something like that. I think if gold is based on the system and everything is translated in that, I think that's how you're going to have your pricing mechanism. And that is where your US dollar is going to start correcting vertical against gold.
Yeah, I think all of this is going to it's going to naturally happen, irrespective of what other people try to do or whatever. And it's going to naturally happen because when commodities get scarce enough, the systems cannot survive that scarcity. The debt-based systems. Remember, debt is just a future repayment. If you can't blow up a future repayment indefinitely in every single country, and there's only a finite amount of commodities on Earth, unless you start going to other areas. And I'm in aerospace, and weight is everything. So I don't know how you're going to get things up there and get them back. I'm like, good luck with that. So the way that I've always viewed this is, I irrespective of what the COMEX has and how much derivative contracts there are backing it, if they are manipulating it, you would see shortages in the physical metals. We aren't seeing that yet. So I don't think they are necessarily manipulating it to that extent. They might do it on short, like blips. I totally agree with that. But they're holding it. What they're doing is they're just holding it on the cost curves. They're holding all these commodities on their cost curves. And then the cost curves are dropping over time because of technological advances and also because of more and more energy. So we'll say a plentiful energy. But that could all reverse with declining ore grades and with energy constraints. And when you see energy constraints in the system, if you go look at Europe, they're like blowing up. I mean, go look at their inflation, go look at all the problems, look at their bond market, look at Japan and their bond market. They're having problems. Like this could be dominoes where it goes ding, 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 and it goes all around. And what I think is happening is Russia and these other countries are like, why are we giving you commodities in exchange for currency? Just because you're the reserve currency? I don't think so. So I think what they're trying to do is they're trying to reprice a fair price to those that have the value in the system. So America, since we're the reserve currency, we're just stealing stuff left and right. Print the money, take it. Print the money, take it. And then force everyone to use our currency. And that's how we remain in power. If they lose the reserve currency, they lose the power because all that money is going to come back. There's no need for it. And it just comes back and buys a bunch of whatever it needs to buy because that's a future repayment.
I think we're going to be okay. I'll cover that at the end. I think we're going to be okay. Yep. So, but there's going to be some pain to get there. And why do I say the second half of the 2020s? Okay. Why that time frame? I obviously, I think there's a recession happening right now that we've been in, that they've changed the definitions of everything around. So currently right now, I think we're in a recession, and the jobs numbers are going to start showing up to confirm that. And with that, at some point in time, we're going to come out of this recession. People are going to want to start buying things again. And with that, there's going to be a deep need for commodities. And you mentioned we're not seeing the shortages in the COMEX, but we're seeing the shortages on the mine side of things. Like I mentioned about silver primary miners. The Silver Institute said, I think it was 160 million ounce deficit last year between what we had and what we used. And think about what that's going to happen in the next 5 or 10 years with all the solar panels and the electric vehicles that are coming about. So the shortage right now is in the mining side of things. That is a future shortage that's coming. And it may not be in the vaults right now. It's showing up in the LME vaults for sure. But the COMEX vaults right now, also, they talk about potentially with rehypothecation, and part of those vaults may be part of SLV, and some of these are never going to sell. So, you know, the point being is that we don't really know the exact amount that's there right now, but we can see with, for instance, the silver primary producers, that they've been run out of business. So there is a supply shortage coming, and that is very explosive as well, because think about this. US might say, hey, we need to make 40 million EVs each year. Well, where the hell are you getting the lithium? Where are you getting the silver? Is it just going to like magically appear? So these shortages are going to start to come about in the second half of 2020. But here's where it gets explosive. Here's the fun part of it. Okay. After that deep recession happens and all these commodities are going to be needed that aren't replenished yet. Okay. You're now running into what you had just talked about. All these ESG constraints that are limiting, it's making the cost of production for these miners to go up, right? Well, think about this. If BRICS plus nations and their exchanges don't require ESG stuff, but we do, it makes the cost of our production much higher than theirs. And think about how this is affecting Europe, where, you know, they're having all kinds of problems with energy. So you're going to have a situation where I believe the back is going to be broken of this whole ESG thing in the next few years, which should help a lot with any of these companies that produce metals to make better profits. So that should help out a lot. So anybody that invests with commodities, a lot of times you're going to be investing in the companies that make them. So that they should be much more profitable when and if this ESG stuff gets broken. But above all, I think many people in the United States, obviously we see Russia versus Ukraine. That's more or less what you would consider a kinetic war. But most people aren't seeing that China, Russia, these guys have been running a trade and supply chain war against us for the better part of 50 years. We didn't even know it. So right now they've been grabbing gold. You can see that over the last year about how these countries have been gobbling up, gold in their vaults. So there's been a trade and supply chain war that's now been going on. You just mentioned about with Russia. Now, what happens when the G7 plus nations, and I call that like our friendlies, okay? They say you're not allowed to buy Russian oil. Okay. Well, Russia turns around and says, well, I'm not selling you any oil. And get this, I'm not selling you any of our uranium. And I'm going to call up Kazakhstan, because Kazatomprom is not selling you guys any uranium either. You now start to have factions of you're not selling you this and I'm not selling you that. And where does it end? I mean, it's an escalation upon escalation. It's all going to start here with energy. But this is going to be very cost inflationary, because think about it. You're reversing globalization. You're now having regionalization, and all these countries now are going to have to start worrying about their own supply chains. So that's going to be a lot more fun too, because the cost of these things, I'm not going to be able to get gold potentially from, essentially Papua New Guinea. I'm going to have to get it from Nevada. But how much is that going to cost with my union labor? So obviously these things will run through exchanges, yada, yada, yada. But, you're going to see that the less globalization you have, the higher these costs of commodities are. So lastly, with this, you can see that I walked you through a little bit of some of how this exchange would work. But long story short with this is like, if you've ever, are you involved with Kinesis at all by any chance?
I'm not, no.
Okay, I don't want to go into that at all, but big picture with that is you can put gold into it and get a gold token out of it. Okay, and in a sense, people are talking about the Chinese CBDCs and how the BRICS might have a CBDCs, and then they're talking about gold, and you could essentially have gold or these other things essentially minted into the system and create the currency right then and there. So this BRICS plus currency I'm talking about, well, how are you going to create it? It's probably going to be based on commodities. So if you have all of these things based off of the value of commodities relative to gold, think about how we see in the United States here about how we feel that gold is severely undervalued to stocks and real estate and the like. And you can go back 100 years and see that. But what then happens is if, the world says, a cattle contract is worth 100 bricks, and we have to then convert gold to this bricks currency, and then we realize that gold in our US dollar terms would cost $5,000 an ounce in order to get cattle from Brazil. That's how this essentially plays out, is that those who are running a lot of these commodities based with gold, it's going to essentially make our currency go vertical in some of these commodities. So I wrote all about this. It's hard to explain some of this in a few words. But I believe that you had mentioned that the US dollar has this world reserve currency. They have these advantages, but I believe with gold flowing to the BRICS plus countries, I believe that this advantage is going to go towards them with as far as being the the market makers for a lot of this. Now, if you look at the US dollars and you look at our exchanges, US dollar is not going away ever anytime soon. If you look at how much stuff is being sold on these exchanges in dollars, but it doesn't mean a rival system can't be set up to undermine some of our US dollar strength. So I believe physical exchanges are going to be the wave of the future with this. And I believe that's what is the crux of this whole BRICS currency. I believe exchanges are going to be driving this whole thing. It's not going to be a fiat BRICS thing that has a floating exchange against the ruble. It's going to be based off of some form of commodities for money. And countries with lack of resources, you think of like, well, if I don't have oil, am I going to have a problem? If I don't have gold, am I going to have a problem? A lot of these countries already have adapted, like Aruba. You ever go there? I mean, it's beautiful. They're great with tourism. They don't really have resources. So, all these countries that don't necessarily have gold or oil, they're not necessarily in problem situation. They have to find other ways to adapt. But where I'm looking at this with the US. So I wrote this article and I got like, I don't know, 50, 60, 70,000 views or whatever it is. It went around everywhere, right? I wrote up some follow-ups on this about, well, how does this affect the US? Nobody read it. Nobody cared. What I could see is when I wrote this article, a lot of people read into this, that this is like the demise of the United States. The US dollar is going down. Look, in the short term, the US dollar relative to the prices of things is going to decrease. So you're going to need more currency units to buy gold and silver. So that's going to be the first wave of it. But with the ridiculous amount of commodities that we produce here, it would just be simply forcing us to go from a fiat-based currency to a commodities type of currency. And that exchange, that would be a relatively simple transition for us. Because think about the United States. We got what? We say we have 8,100 tons of gold in our vaults. What if we borrowed against them? We don't. We just print money and we'll give you treasuries and all this other fun stuff. But the point is that it can drive us away from printing dollars and force us to back our currency with some form of tangible good. So it prevents us from getting $200 trillion in debt. We have to actually have the cattle. We actually have to have the gold and the silver in the ground. So you can still lever up against it. You can still borrow against it and do a reserve currency against it. But what it does is it limits you. So you can't have these stupid things like 600 contracts for every ounce of gold or whatever that number is. It prevents that type of price suppression across everything. So I believe the next 5 to 10 years is going to have a world with real price discovery with real exchanges. And that is ultimately where that was going. I think the United States is going to be just fine. It's going to hurt in the short term as people start to think about money as commodities instead of US dollars. So that's kind of the overview about, where this went. There's probably another 60,000 words I didn't cover in that, but you get the idea.
Mhm. Mhm. Yeah, I like it. I think it's probably true. Commodities is where all the value is at. And I'm still kind of dumbfounded how the financial players are making so much money versus the people who actually make real things and the countries that have the real things. Because commodities, the way that I view it, is that's where all the wealth is. I mean, that is what you want. You can't make a computer without commodities. You can't make all these different things that we use on a daily perspective without using commodities. And then the money should just be an extension of the value that that country or continent produces. And that's really the backing of either food, commodities, whatever the heck it is. So I think it will get repriced
But
naturally.
right now, if you think about it, you can borrow against your company and issue bonds. You can borrow against your home, do a home equity loan.
Mhm.
Countries, I believe, are then going to say, hey, here are my resources. Let me borrow against them. And that's going to be a better form of currency. Because it's going to be, to my understanding here, I believe the exchanges are what drive everything. And without a functioning exchange, your currency is garbage. And I believe that what this is going to do is start with a gold based type of system, not gold backed. I believe that's going to force a more honest form of money. So it will prevent the abuse of anybody to be able to create a world currency reserve and then abuse everyone with it. I think that if all of this stuff is priced in gold grams, that is a universal translator across the world. Every country has some, except for Canada. and Canada, if they wanted to, they can pull a Ghana, and with all the gold that they pull out of the ground, they can say, look, we'll give you 20% of all the gold you produce. We'll give you Canadian dollars. You give us some gold and we'll put it in our reserves. And that'll be there for our rainy day fund. So,
Mhm.
there's a way that, we can do this moving forward that does not include nationalization. That's the first thing everybody talks about. Now, look at what happened to Brazil. Sorry, I keep confusing. Sorry, what happened with Venezuela when they did
Mhm.
their nationalization with oil and gas, and look what 5-8 years later is when their currency started hyperinflating
Inflating.
because
Mhm.
nobody was investing in their country anymore. So you see lessons like that, and you say, how can I make a better mousetrap than that, and take care of my government and get the commodities for the people? Well, I think Ghana, I think this is a completely underreported type of thing. But when they did that and they said, look, we'll give you 20% of our 20% of your gold you sell to us in SETI, and that will stabilize our currency. We do not then need to take this gold and get US dollars to pay things. I can just take this gold now and buy oil from Russia with it. So it prevents them from ever needing to do the US dollar. So it keeps their currency from depreciating against the US dollar currency. Because I mean, I don't know about you, but I'm not going to my local 7-Eleven or something and trying to pay for things in SETI. So
Mhm.
what this does is this allows smaller countries to defend their currency as well. And this keeps, think about the risk of jurisdictions in Africa. I believe as part of this as well, the next 50 years, Africa is going to be the place to be for commodities. However, look how unsafe their jurisdictions are. But one of the big problems that you have, look at Zimbabwe, look at the currency. When you have currency problems, why is that? I mean, everything is going to zero, and then it creates wars. And if you can create stabilized money, and you can have those people that are working in these jurisdictions get an honest paycheck for these things, it brings them up out of poverty. It gives these places strength. And I can tell you, I think that I invest a little bit in some gold mines in Africa. And I think I believe that there's pockets of jurisdictions there right now that are very exciting. And I think that there's a lot of security issues there now that I believe if you fix all the money and these people start selling things on BRICS Plus exchanges, it's going to fix a lot of the infrastructure there and create a lot of better security situations in countries like and continents like that. So
Yeah, I agree. I agree. Yeah, the only thing I've got my eyes on is very oil related, energy related stuff, and that's where things in the system can go wrong with energy. So I'm continuing to watch energy. I want to see if we can actually produce more oil I don't think electric vehicles are going to solve anything. It's not going to. We don't have enough minerals in the world in reserves to actually satisfy how many electric vehicles they want to make. That's why my eye goes to oil, because it's like we don't have the options they're trying to put in place are not very good solutions. So I continue to watch oil, because if they try to ramp these commodities up, you're going to get into shortages of oil. And that's where all the pressure is going to mount and build. I think the Middle East, Saudi Arabia, does not have any spare capacity. I think they're basically tapped out. I think the entire Middle East is in general. And commodities are just a derivative of energy, all these metals. And that's where I keep looking, because if you get a problem in energy and it stays a problem, and it could stay a problem the rest of our lives, then I think the whole thing will just change. It'll be a dramatic shift in the paradigm of the way everyone views this world. It's not going to be like the past 100 years of industrial. It's going to have to be maybe perhaps something different. I don't know. I don't know what the technology we're going to use to try to solve it. Maybe there's artificial intelligence that they can try to use to solve this stuff. I don't know. But it could be a game changer. I'm just not so sure. But that's where I'm looking. That's where I'm always checking, because I think currencies, what I think will happen is if you have an energy constraint, you'll start to see bonds start to have problems. And what are we seeing? Bonds are having problems in England. Bonds are having problems in yen. It's like it's starting. So I agree with everything, the commodity. I'm just wondering if we can get to the other side in the next few years to get there.
Yeah. There was also something you were mentioning about with the bonds and treasuries, and all this stuff is pretty much elevated right now. But if you think about it, I talked about defensive assets, and a lot of people would go into, traditionally, they would go into treasuries and a sliver of that into gold. But if you think about it, and all these people are selling stocks and all these people are selling real estate and they want to put something into it, well, you have to understand right now, the Fed and nation states are selling treasuries hand over fist. And what that's doing is it's going to be keeping the interest rates elevated for quite some time. As long as they keep trying to unwind. I mean, China tomorrow can drop 700 billion of treasuries if they wanted to. The problem with it being is that would destabilize us, and we're their biggest buyer of things. So they want to have, there's a rival system going on here, but if you have a situation where these bonds are not going to go from 4% down to 1% anytime soon, then you would think that people may actually move into gold and not necessarily these bonds, because they're not going to appreciate in any kind of value at all. There's constant selling pressure that I can see in the next 2 to 3 years as people try and get out of treasuries, people try and get out of dollars. And what are they doing with the dollars? Follow the banks. They're buying gold.
Mm-hmm. Yeah, they're going to, dollars will be extinguished and they'll buy commodities with it. That's my opinions. And they're going to buy whatever they can. And there's other commodities where, palladium is 65% produced by Russia. And then you've got
platinum is up there too. Yeah.
80% with South Africa, 70 something, 80%. And then they also produce 30% Russia does with platinum. So there's certain commodities where I don't know what would happen if they just said, we're not going to export these to you.
Well, yeah, that's where we're getting at with this. We're trying to force G7 countries not to buy. We're going to cap Russian oil. And then Russia turns around and says, fine, I'm just not going to sell to you. Right. Where do you go from there? It's an escalation. And I just think that many people have absolutely zero idea there has been a trade war actually probably going on for 50 years. We had been so-called winning it, so to speak, with the strong dollar. But what do? You start to attack the dollar. And this is kind of what you do. You form alternatives. You open up the market to different types of currency. And, especially when they did this with Russia, with SWIFT, now it's having people starting to go, maybe I should start buying some gold, or, buying some yuan, or buying oil, or whatever it is, get out of dollars. That's where I think, the drive of this whole thesis, I believe, is driven from that. As the driver to escalate this a lot faster. It's going to be accelerating a move away from that as a reserve. So who knows? Maybe it goes down another 5% in 10 years, and this is all bunk. But I tend to think that what we're seeing over the last year since this Russia thing happened, all these people are buying gold. And I think you're going to see a lot of people getting out of treasuries.
Definitely. Definitely. I agree with that too. I think the thing that's going to be different is we've always looked backwards in a world or an earth that's had surpluses of everything. Absolutely everything. Surplus of copper, surplus of any mineral that you want and any energy source, natural gas, oil, et cetera, et cetera, et cetera. If there is a constraint in one of those, a couple of those major things, we'll call it energy. What it's going to do is it's going to price things completely different, in my opinion. It's not going to be priced off of this gigantic surplus of copper. Now it's, well, what is the value to society and to humans of this metal? It's not priced off of the cost curve. It's priced off something completely different. And I don't know what that looks like. I'm still trying to figure that out myself. I'm like, all right, if we have an energy constraint anywhere in this world now, that puts oil to $300 or $400 a barrel. Like one country that's a major producer gets in a war and that oil comes offline. It's like, okay, we're 5 or 10 million barrels short on a worldwide basis with declining production. And if we're at kind of like a peakish type move, what's the value of copper? What's the value of nickel? What's the value of all these things if you need it to run your facilities?
That's the thing I was getting back to, is the gold to commodities ratios. Like, what's the saying? Over the last 500 years, an ounce of gold is worth a fine man's suit. Well, it's not the suit, it's the commodities and the labor that went into making it. And obviously some of these things decrease in cost every year with automation and efficiencies. But the concept is that the gold to oil ratio, the gold to copper ratio, gold is the center of all of these types of things. And when you're talking about value, everyone thinks of things in US dollar terms. Well, a barrel of oil was what, $2 in 1972, and it's what, $80 now. Did oil appreciate by 40 times? Or did the value of the currency go down by 80%? So you have to start thinking in the next 5 or 10 years of what actually money is, as opposed to what currency is. And if you can start finding the value in the gold as opposed to the dollar amount in the gold, at some future point you can redeem that value at a much higher currency rate.
Yeah, the thing, I don't know if hopefully you're understanding the argument here. So if you have energy constraints large enough, the metal in the ground will never get lifted out of the ground, because we're going to have to divert energy towards food production and other things. And that's where I get like, what's the value of something like a piece of silver in your hand if everybody wants it and not much more is coming out of the ground? That's going to be ultra valuable, right?
Well, you run into those situations where you'll have some of those guys out there. They'll be like, well, there is 60 billion ounces of silver above ground. However, a lot of this is sitting in a dump somewhere. It's in grandma's tea sets, it's in TVs, it's in toasters that are in dumps. And if silver does hit a point where it's $125, $150 an ounce, you know what? Maybe you're having people mining silver out of dumps. That doesn't necessarily need diesel to strip, a whole mountain to get some silver out. If silver is involved with all these, used appliances and stuff, and, it's $150 to $200 an ounce, there are other means of then recycling also. I mean, we're doing this with gold recycling now. I conflated this whole thing, about a year ago, but, the only silver recycling you can ever do today that's worthwhile is as a byproduct of gold. So, they may use chemicals for all this kind of stuff. And if you're looking at it, I think it's like, I don't know, 100, 200 million ounces or something like that of silver is just from recycling. So it's not like they necessarily have to go and dig it out of the ground with diesel. So there's other means potentially, as prices rise, of getting this without necessarily going into the ground with diesel. These processes might cost more. And yeah, you might need diesel to create some of these other processes. But the point is, you don't necessarily have to go strip mining and go for copper. So.
Yeah, I got you. Do you have anything else you'd like to share? Or any other questions that you have?
No, I write these blogs, and you know what? It keeps me sane. My wife thinks I'm nuts with all my silver and gold talk. So I appreciate the ability to kind of have conversations like this, because even in my home life, my friends think I'm a silver bug. So definitely appreciate having a conversation, and take a look at my 60,000 word blogs at renaissancemen.org.
Mhm. And you have a Twitter too, I think. If someone wanted to reach out to you or follow your work, where do they go?
At Nate Fish PA. I've only been there a couple years, and wow, just I love it. So
Yeah, it's pretty cool on Twitter, because that's where I reached out to you. So, all right, guys. Well, that's all I've got. So hopefully, if you made it to the end, definitely check out his Twitter. And that's all we've got. So we'll catch you next time. This is Finding Value.